punishment is so small given the amount of revenue generated over the same period of time. It seems that Citadel has at least an opportunity to build into its cost of doing business paying penalties. And that concerns me. It concerns me that the punishment doesn't seem to deter Citadel. It concerns me because I know of circumstances wherein persons who are not in the market, they do things that are much less harmful, and they can possibly go to jail. So the question that I have is this: what kinds of systems do we have in place? And it's back to you again, ma'am, to prevent the very things that I have called to the attention of my colleagues.
Well, as a former enforcement attorney at FINRA, I can say that regulators have the same concern with fines and other punishments becoming just a cost of doing business. And it's one of the things that are considered along with the regulations around what can be punished.
The gentleman's
May I, for the record,
has expired. Mr. Green, as you know, we're going to have a series of hearings, and our next panel will include a whole bevy of experts also on some of these issues. With that, Mr. Barr, you're ready.
May I say something in the record, please? I have additional questions.
Without objection, you may enter into the record. Thank you.
Thank you.
Mr. Barr, you're recognized for 5 minutes.
Thank you, Madam Chair. And Mr. Griffin, I want to revisit this issue of payment for order flow. Payment for order flow has been around for decades, correct?
So I know it's been around for at least 1 or 2 decades. I can't answer before that period of time.
And it's a recognized and approved practice by the SEC, correct?
Yes, it is.
And payment for order flow is set by the brokerage firm, not the wholesaler, right?
It is ultimately a negotiated number, but it is a number that is set by the brokerage firm and not by us as the market maker.
Well, as a market maker that provides execution services to retail brokers, you are required to meet best execution requirements. Is that correct?
Yes, it is.
And in other words, market makers are required to provide the same or better pricing than the exchanges, correct?
That is correct.
And how can market makers offer that better pricing to Mr. Sherman's line of questions?
So there are a number of drivers that permit us to offer better pricing than what is available on exchange. The first is that exchanges have legally mandated minimum tick sizes of a penny. So if you look at a stock like AMC, it trades $5 bid, 501 offered. If the exchange could trade with a half-cent increment, it would probably trade $5, 0.005 bid, 501 offered, or vice versa. But the exchanges are limited to a 1 cent minimum tick size. And we have been clear on the record in prior testimony that exchanges should be permitted to have a smaller and more competitive tick size. That's factor number one.
Okay.
Number two is that the average retail order is much smaller in totality than the average order that goes onto an exchange. Because this order is smaller, and I'll share a number with you, the typical Robinhood order is ballpark about $2,000 in size. Because it's a small order, the amount of risk that we need to assume in managing that order is relatively small as compared to an order that we have to manage from our on-exchange trading. And as I'm sure you're well aware, we are the largest trader of stocks on exchanges in the United States. So let
me move to Mr. Tenev really quickly on that point. What impact might greater restrictions on the payment for order flow model have on your ability to offer zero commission trades?
We do believe, Congressman, that that's an important question, and payment for order flow helps cover the costs of running our business and offer commission-free trading to customers. When we started, people didn't even think that there was enough margin left to make this business work, but we've been fortunate to make it work and to make it work for our customers.
Well, let's talk about why Robinhood restricted trades. I think your explanation about margin requirements charged by your clearinghouse makes sense. Is your clearinghouse supervised by the Fed and the SEC?
I believe that's
are the margin requirements charged by your clearinghouse in turn approved by federal regulators?
Yes.
And did federal regulators approve the value at risk charge that was imposed on Robinhood?
I believe, Congressman, the value at risk charge is outlined in general terms in Dodd-Frank, but I'm not sure who approved the specific implementation of that formula.
So if anyone has a problem with your decision to halt trades, it's fair to say that their frustration should be directed toward federal regulation.
Congressman, I'm not trying to throw anyone under the bus and direct frustration anywhere. All I can say is Robinhood Securities played this by the books and played it basically the only way that we could remain in compliance with our deposit requirements.
Mr. Plotkin, I appreciate your testimony that Melvin always follows laws governing shorting stock, but Melvin lost $6 billion in 20 trading days. Let me ask you about your risk management. Did your short positions exceed float?
No, they did not.
Well, shorting has an important role to play in our markets, allowing for legitimate hedging and price discovery. But we are interested in naked shorting, and so we would hope that you would clarify that and how it is that you make sure that you're first locating the borrow.
Time has expired. Mr. Cleaver, you're recognized for 5 minutes.
Thank you, Madam Chair. And I too would like to thank you for this hearing. It's a question that a lot of people are asking, probably many of us as we go throughout our districts. But let me start with you, Mr. Tanev. I'm just curious if you can give it to me in a short period of time. How did you come up with your name for your company?
Absolutely. Thank you for that question, Congressman. Robinhood stands for lowering the barrier to entry and democratizing finance for all. So the idea is the same tools that institutions and wealthier, high net worth individuals have had for a long time should be available to the people, regardless of their net worth or how much money they have.
Okay, I appreciate that answer. Because it's something I would also embrace. However, I have a 23-year-old on the other side of the house who I love dearly, but he has no training, no income, no qualifications. How in the world could he get like $1 million worth of leverage?
Thank you, Congressman. So the leverage that we provide to our customers, which less than 3% of our customers actively use, is regulated strictly by requirements. So the only way to get that amount of leverage in a margin account through borrowing is to deposit a similarly sized amount of capital.
Or by mistake.
Congressman, I'm not sure what you're referring to.
Well, I mean, there's a record of a young man getting $1 million worth of leverage. He was only 20 years old. So I'm just saying, if that's not a policy, that was an error.
Congressman, I appreciate the opportunity to address that really important point. You're referring to Mr. Kearns.
I am.
The man who unfortunately passed last year.
Yes.
First of all, I'm sorry to the family of Mr. Kearns for your loss. the passing of Mr. Kearns was deeply troubling to me and to the entire company. And we have vowed to take a series of steps, very aggressive steps, to make our options product safer for our customers, including changing the customer interface, adding more additional options education, as well as strengthening and tightening the requirements for people getting options, and adding a live customer support line for acute options cases. So it was a tragedy, and we went into immediate action to make sure that we made not just the most accessible options trading product for our customers, but the safest as well.
Okay, I asked that question. In my real life, I'm a United Methodist pastor, and so I've read your statement. After the tragedy of this young 20-year-old, but I mean, and I don't think you nor I want to get in. I mean, to litigate that right here today. But what improvements did you make in the aftermath to your platform, or were there improvements?
Thank you, Congressman. There were several improvements. One, we added the ability to instant exercise as well as exercise options positions in app. We clarified the display of buying power, specifically negative buying power, in situations where one leg of a complex multi-leg options transaction were to be assigned. We also added an options education specialist. We also added live phone-based customer support for acute options cases, which has gotten very, very great feedback from customers and is something we're expanding to other use cases, such as cases where customers' accounts have had off-platform hacking incidents.
Okay, that's the last one is where I was concentrating on, because this young man was trying to get into your system to find out what was going on. He was confused. He was scared, and so he sent emails. To be fair, there was a response, but it was like, hours later. And so as I became more and more familiar with this particular case.
The gentleman's time has expired.
Thank you, Madam. Thank you, Madam Chair. I appreciate it.
You're so welcome. Mr. Hill, you're recognized for 5 minutes.
Well, thank you, Madam Chair, for holding this hearing, and I want to thank our witnesses for their expertise and their patience. Madam Chair, I have a letter from the American Securities Association I'd like to insert in the record, please.
Without objection, such is the order.
Thank you very much. And Mr. Tenev, what a treat to see you, and congratulations on being part of the American dream. I had the pleasure working for President Bush 41, of working in Sofia in 1990 and 1991 to try to bring capitalism to Bulgaria after the wall fell. So I'm glad to see you're an American citizen and innovating here in our country.
Thank you.
I think you've done a good job talking about I'd say the acknowledged lesson that you've learned in terms of these deposits for clearing and the important risk management issue for your firm. So I'd like to turn to follow up on some of the discussions about retail service that you've also touched on today. Do you have a call center generally for Robinhood investors?
Thank you for that question, Congressman. And I want to start by saying customer service is fundamental to everything that we do, and it's one of the areas where we're investing the most. We have customer service centers in a number of states: Colorado, Florida, Texas, and Arizona, and we're looking to expand aggressively.
Do you have a call center that I can call, a 1-800 number, if I'm having a trouble in the middle of the trading day?
We do offer, Congressman, live phone support in app for certain use cases. We're expanding that as fast as we can. Yeah. So as I mentioned earlier, options, advanced options cases, as well as account takeovers, which typically happen through a customer's personal email who's been compromised. And the feedback's been great, and we're looking to expand the live phone channel, as well as make improvements to our email channel and even upstream within the product.
Thank you. That's helpful. And on the subject of margin and options, you've talked about that today. But I've spent 40 years in this business and been the general securities principal in 3 different firms. And this issue of granting margin and option approval to retail clients is always an important issue. You've addressed that today, so I want to turn to a different topic that has not been raised, and that's low dollar stocks. As I understand it, your policy and procedure manual simply said that you allow low dollar stocks if they're on an exchange, but many brokerage firms are very reticent to allow retail investors to invest in stocks that are under $5. Could you address that issue today?
Yes, I'd be happy to, Congressman. So Robinhood allows customers to trade in and invest in exchange-listed securities. So that's the objective criteria that we use. And it actually excludes several types of securities that customers commonly request to trade in. So on Robinhood, you can't trade over-the-counter bulletin boards, except in limited cases where a listed stock falls to over-the-counter. You can't trade pink sheets. And of course, you can't short sell or enter undefined risk options trades.
Okay.
So our objective criteria involve whether exchanges list these securities.
Thank you. And I think that probably, I'm sure you'll reevaluate that after these effects. Let me turn to Ms. Schullup. Thank you for being here. The Wall Street Bets Reddit platform. I'm curious, when you think about the obligation of this SEC pending investigation, based on your FINRA background, do you think the SEC should look at the bulletin board participants under Section 9A2 on potentially inducing trading in a certain direction? Is that worthy of their review?
Thank you for the question, Congressman. I think that there's been little evidence to this time that there's been any sort of false or deceptive conduct taking place on the Wall Street's Bets Forum. That does not mean, though, that I think that the SEC should not take a deeper look. Because of the anonymity in the forum, there could have been people that were engaging in deceptive behavior that's not readily apparent to outside and to the public. So I do think the SEC should look, but to this point, I've seen very little that would meet a test for manipulation, which generally involves false or deceptive behavior.
Thank you. I appreciate that. Mr. Tiev, I thought of another question for you. Would a securities transaction tax be beneficial to retail investors in the United States?
Thank you, Congressman. I don't believe it would.
Thank you.
Gentleman's time has expired.
Thank you, Madam Chair. You're back.
Witnesses, we will take a short recess. The committee stands in recess for 5 minutes. Thank you.
Good afternoon, everyone. You have been watching live testimony before the House Financial Services Committee as lawmakers grill some of the key players in the GameStop trading frenzy, including the CEO of Robinhood, of Reddit, of Citadel as well. We're going to resume that testimony once they get back to business, but we want to pause here for a moment, take a look at the markets, but also get some analysis on what you just heard. Lawmakers began this testimony at noon Eastern time today. This is the first break they've taken, so they've been going for 2 hours plus. And someone else who's been listening along with all of us is Professor Jesse Freed. He is a Harvard Law professor. Thank you so much for joining us. There's a lot to digest there. I'm just going to start with an overarching question. You saw Robinhood CEO answer lots of questions, lots of criticism coming from lawmakers on how his firm handled the GameStop trading frenzy. Just what's your big takeaway from the way Vlad Tenev is conducting himself today?
Well, I think he did a really great job defending himself and Robinhood. He came across as a very sympathetic person who came here from Bulgaria, built a business, is trying to do the right thing. And look, GameStop was, as he said, an unexpected event. It's not something that one could anticipate. And so when things go haywire, when something happens that's not really anticipatable, it's not proper or constructive to blame people who didn't anticipate it.
I want to go through what some of the lawmakers had to say to Tenev today, and one of them is a Democrat from New York, Carolyn Maloney. She accused Vlad Tenev of recklessly handling customer money when they stopped also allowing people to be able to buy the shares during the trading frenzy. And she said, quote, "You reserve the right to make up the rules as you go along." And then he responded by saying that he was sorry. He said, "I'm not going to say that Robinhood did everything perfect." It's at times like these when lawmakers are dealing with some heady subjects that they are not necessarily experts in, trying to make sense of it all. Is Robinhood and firms like them making up the rules as they go, or did the markets do what they were supposed to do during those trading frenzied days?
So I think precisely because something like GameStop is not really anticipatable, and other things like GameStop might happen in the future, companies like Robinhood have to be able to stop or limit trading based on their judgment as to what is going to happen. And you can't figure out all the different possible scenarios in advance where trading is going to be needed to be limited. And so you have to have something open-ended in your disclosure, which says, if we feel the need to do this, we will limit trading.
So do you think that we're going to see any real change come out of this, what's probably going to be marathon testimony today? Or is it really the Securities and Exchange Commission who's going to be taking a deeper look into what happened? If any change comes, it would come from the SEC versus lawmakers, do you think?
So the SEC is investigating trading in GameStop, and it might be the case that they find that there was manipulation via Reddit. I sort of doubt that they're going to find that, but we can't rule it out. If they find out that there was no manipulation via Reddit, there's really nothing for them to do in terms of limiting how people communicate on these chat boards or trading in these stocks. There are real issues in how the financial system is regulated around settlement times, which probably should be addressed. Other than that, I'm not really sure what needs to be done at this point, given that there's no evidence so far that there was manipulation.
They also came down pretty hard on payment for order flow, that controversial practice in which stockbrokers get a kickback for essentially selling the ability to execute trades. This was coming from Representative Brad Sherman, the Democrat from California. And we know that Robinhood was fined by FINRA $1.25 million. I think it was a couple of years ago for this practice. Do you think that we may need to start seeing more transparency or different rules around this controversial payment for order flow because of all of this?
I think more disclosure can't hurt. I'm sort of skeptical that payment for order flow had anything to do with what happened in GameStop. I think that the people that were getting very excited about GameStop would have gotten just as excited if there had been big, bold disclosures throughout the Robinhood platform and other platforms that there was payment for order flow. I just think it's a bit of a side issue.
I actually want to play a soundbite for a moment from Congressman Gregory Meeks from today's testimony, and then we'll have a chat about it.
How do you make determination of individuals who are not the sophisticated investors and allowing them to buy these risky stocks that are on margin?
Thank you, Congressman, for the opportunity to address that. Let me set the stage a little bit by saying that about 2% of our customers borrow on margin. About 13% on a monthly basis perform an options transaction, and a much smaller number, around 3%, perform a multi-leg options transaction. So the vast majority of our customers are engaging in buy and hold activities. and long-term investing on our platform.
What do you make of how Tenev answered that question? And do you think that we might see, at the very least, we're seeing calls for more transparency, but do you think we'll end up with some different rules coming out of this for platforms like Robinhood?
So it looks like a lot of people on Robinhood are trading options, which generally is a loser's game. I think that regulators in a sort of a non-politicized system looking at this might say, hey, you can't trade options, or you can't borrow buy stocks on margin if you have less than a certain amount of income or your account is smaller than a certain size. I think that might be a reasonable step to take to protect people from themselves. But I think that politically, these types of reforms are not going to really go anywhere, because there'll be a lot of angry people out there. If
Professor, sorry,
tell them.
We actually want to resume the testimony. Let's do that now.
When you started investing in it?
At the time, it was in the ballpark of around $5 per share.
Okay. And in your analysis, what did you think a proper price for the share was? Because you thought you were getting a good buy.
Sure. At the time, I thought that the value of the business could be worth up to roughly $2 billion.
Okay, but how much is that per share? Just let's bring it back to you bought at 5, you thought it was worth 10, 20?
I felt as though that it could be worth, at the time, in the range of, say, $20 to $25 per share.
Okay. And you continued to invest on and off through 2019 and 2020. Is that true?
Yes.
Okay. And you also, you bought some shares, but you also did some options trading, did you not?
Correct. I did.
And options trading is not really for the novice investor, is it?
It is a riskier investment, yes.
Okay. On January 27th, I think the stock price hit $483 or something like that. Is that true?
I believe it was in that area, yes.
In your analysis, back when you started investing in the stock, did you ever see it being valued at $483 per share?
At the time, I thought it was possible, but a very low probability, I thought.
Okay, thank you. Just a couple more questions. In terms of the platforms where you visited and discussed this stock with others, one was the Reddit subreddit, Wall Street Bets platform, correct?
Correct.
And at any given time, how many people were you talking to on that platform?
I wasn't so much talking to anyone individually, but rather making posts on that public forum.
That GameStop was an attractive stock.
Yeah, early on, I had felt that it was an attractive investment opportunity, and I had shared some of my thoughts as to why that was.
Did you discuss this on any other platforms? Are there any other kinds of Reddit or other kinds of platforms that you talked about the stock?
Yes, I have talked about the stock on some other platforms.
Okay. Did you ever talk about the short sellers that had bet against this company?
Yes, the topic did come up.
And about when did that occur?
Oh, since around the time I had begun investing in it, it was, as someone else has noted, it was an exceptional level of short interest in the stock since the time I had started investing in it.
Okay. Let me turn my attention now to you, Mr. Plotkin. When did Melvin first take a short position in GameStop?
Thank you, Congressman. That was in 2014, really right at our inception of the fund.
And when you did that, did you continue to maintain a short position?
That's correct.
So you said you analyzed the value of the stock And you, by taking a short position, you, unlike Mr. Gill, thought that the stock was overpriced. He thought it was underpriced. You thought it was overpriced.
That's a good conclusion. Yes.
Okay. In your analysis, when you started into the short position, what did you think the stock was worth?
I don't remember exactly at the time. I think when we launched, it was probably a $40 stock. I think we believe the company had a lot of, structural challenges. We've seen their earnings go from, I think, north of $3 a share to almost negative $3 a share. So there's been a lot of challenges fundamentally.
All right. Last question for you. Were you in a naked position in your short position because the stock was oversold?
No, our systems won't even allow that. So that would be impossible for us to do.
Okay. Well, thank you. My time's expired. I wanted to get some facts out for Mr. McHenry, and I yield back.
Thank you very much. The gentleman's time has expired. Mr. Emmer?
We thank you.
Nice for 5 minutes.
Thank you, Madam Chair, Ranking Member McHenry, for holding this hearing. Thank you to the witnesses for being here today. I represent the 1st Congressional District of New York, which encompasses much of Suffolk County on Long Island. My home district is full of people from all different walks of life and industries, and having access to cost-efficient investing is crucial. While there are always ways to make a system work better, our capital markets are the envy of the world with their liquidity and diversity of investment opportunities. Innovations in securities trading brought by the private sector have increased access for retail investors. For better or for worse, and this situation is a perfect example. For example, one of our witnesses here, Mr. Gill, or should I say Roaring Kitty, turned $53,000 into almost $50 million, and that's what you would call some deep you-know-what value. Of course, we know that not all those who invested in these stocks share the same success story. However, I want to highlight a potential vulnerability in these innovations. I've been concerned for some time in general with the sharing of U.S. individual user data with the Chinese Communist Party. I sent a letter, for example, to the Treasury Department in October 2019 expressing concern with the potential sharing of user information by TikTok to its parent company ByteDance and asked for a CFIUS review. Chinese companies are required by law to regulate online behavior that deviates from the political goals of the CCP, obey the CCP's censorship directives, and participate in China's espionage. These policies regulate companies like TikTok in the China market and increasingly their overseas business. Webull and Moomoo are two examples of broker-dealers that are subsidiaries of Chinese parent companies. According to Bloomberg, funds affiliated with Xiaomi Corp own at least 14% of Webull. Xiaomi is a Chinese company that risks being delisted from U.S. exchanges after the U.S. Department of Defense put the company on a blacklist on January 14, 2021. Moomoo is owned by Futu Holdings, which is a company that received a significant investment from entities affiliated with Tencent, a company with known ties to the CCP. On December 8, 2020, Bloomberg Businessweek ran an article on Webull stating the company, quote, has increased its roster of brokerage clients by about tenfold this year to more than 2 million by offering free stock trades with a slick online interface. On January 29, 2020, the day after trading activity for long trades on certain stocks discussed on Reddit threads were limited, Bloomberg ran an article with the headline, Robinhood rival Webull sees 16-fold jump in new trading accounts. It's clear that these apps have rapidly increased their user base, which has me concerned. Ms. Schulp, do you think we should be concerned about the potential for Chinese entities with ties to the CCP receiving personally identifiable information or other user data from their subsidiary broker-dealers that are licensed and registered in the U.S.?
I think it's a potential national security concern, which is a bit outside of my area of expertise. What I can say is that the rules that the brokers have to apply and comply with regarding personally identifiable information and other material data should be applied equally to companies that are based offshore and companies that are based onshore. And I hope that that's the case with respect to Webull or any other competitors that are not domestically owned.
Having a diversity of choice for different trading apps is generally good for market competition. However, is it a good outcome for millions of Americans to flood into trading apps that could be required to share user data to parent companies that have ties to the CCP?
Again, I think choice is key here, as well as understanding from a consumer perspective what companies you are choosing to do business with. Again, the national security concerns are a bit outside of my area of expertise.
Well, I thank you for being here. This is another angle to this issue with these new options that are being provided to average retail investors. And we want these retail investors to have the most amount of information as possible to be set up for success. I yield back.
Thank you very much. Mr. Himes, you are recognized for 5 minutes.
Thank you, Madam Chair, and a big thank you to our panel today for a very interesting conversation. One of the chairwoman's ways of characterizing this hearing was who wins and who loses. And I've spent a bunch of time in the last couple of days looking at the various players here. I'm pretty convinced that the wholesalers, Citadel is one of the winners. They make a lot of money. They're the casino in this story, and the casino tends to win over time. Robinhood has a valuation of $5.6 billion and makes a lot of money from the casino. So who loses? And I want to spend some time talking about the person who usually loses, and that's the retail investor. And while I have supported for many years the democratization of finance, as we say, it's not just in Washington, D.C., but on Wall Street. The retail investor is known as dumb money. And there are any number of structures that are set up to take advantage of the retail investor. And I think it's worth looking at that because as much as we're celebrating Mr. Gill here, we're not talking very much about Mr. Salvador Vergara, who was featured in a Wall Street Journal story, who took out a $20,000 personal loan through Robinhood, invested it in GameStop, only to see the value of his position go down 80%. So Mr. Vergara is out $16,000 he doesn't have, that he owes to somebody else. And as much as I support the democratization of finance, we need to be thoughtful about this. So, Mr. Tenev, my question is for you. You quoted a $35 billion number as what I interpreted to be profits in excess of deposited funds and securities. If you just look at your customers who traded in GameStop over the period of its increase and subsequent decrease, Mr. Tenev, how did your customers in the aggregate do? Did they win or did they lose?
Thank you, Congressman, for that question. I don't have that particular cut of the data top of mind, so maybe we can get back to you on that one.
All right, you don't have that. So you do have a $35 billion figure. The figure doesn't mean a lot to me because it's just a dollar number. Help me convert that to a rate of return. First of all, is that $35 billion, is that gross or net? In other words, is that actual profit or does it include margin shares, other forms of leverage that may actually not belong to the account holder?
It does include, Congressman, unrealized gains. So it's the value of assets, both including positions in securities and cryptocurrencies.
Okay, I get that. I get that. But again, $35 billion doesn't mean anything to me unless you can convert that into a rate of return. So do that for me. What is that on what asset under management number is that $35 billion unrealized against?
The asset under management number is not one that Robinhood has publicly shared.
Okay, but you can't share $35 billion. Sorry, Mr. Tenev, I just don't have a lot of time. $35 billion is a meaningless number. I need to know what that is in terms of return. So convert that for me into rate of return. So I can compare it to Treasury, so I can compare it to the S&P 500.
Congressman, with respect, I think the proper comparison is to customers not investing at all. Much of our customers are investing for the first time. and are taking money that they otherwise would have spent or consumed and putting it into
Mr. Tenev, again, I don't want to be rude, but it's my time. Again, you offered up the $35 billion number, which, as you and anybody else schooled in finance knows, is meaningless unless you convert it into a rate of return. So just please convert that $35 billion number, which to the folks watching at home sounds like a lot of money. But what does that actually convert to in terms of rate of return, which is what matters?
Congressman, $35 billion is indeed a large amount of money, especially for our customers who are mostly small investors. It's more than most corporations, nearly all corporations have paid.
Mr. Tenev, again, don't make me be rude here. You and I both know that $35 billion of unrealized gains, if that's on a base of $100 billion, that's a 35% of return. If that's under $1 trillion, it's a radically different rate of return. So what I'm trying to get at, Mr. Tenev, here is you threw out the number of $35 billion. I actually think the right comparison is, what if your clients had simply invested in the long run in an S&P index fund? Would that number be more than $35 billion or less?
Congressman, with respect, I don't believe the right comparison is investing in an S&P index fund. I think the right comparison is not having invested at all and having instead spent that money and consumed it.
No, it's most certainly not. It's most certainly not, Mr. Tenev. And so I'm going to ask you, I'm out of time, but again, you put out the $35 billion number. So I think it's only decent, because you and I both know that a hard dollar number is meaningless unless you can convert it to return. So I'm going to ask you to convert that. Obviously, I'm out of time, into a rate of return for us.
You're out of time. Mr. Laudermilk, you now recognized for 5 minutes.
Thank you, Madam Chair, and I appreciate all the members of the panel being here. I think you've seen that there are occasions with some on the committee here that if you're not giving them the answer that they want, that they can use, they're just going to continue to push on you. And I just encourage you to continue speaking the truth, and you'll always stand up head and shoulders above everyone. Not surprisingly, the situation with GameStop trading has resulted in commentators and even some of my colleagues engaging in knee-jerk reactions, calling for new laws and regulations to be hastily enacted. It just seems to be a trend in Washington, D.C. to never let a crisis go to waste. Some have even spread conspiracy theories and alleged that crimes were committed before knowing what even happened. I can even testify to what was just being said. Is I know numbers of people, personal friends, who have never invested before, but because of Robinhood and other retail platforms, many of them took the stimulus money that they received during the CARES Act, which they were still working, they didn't need, and they actually started an account and started investing. So yes, more and more people who have never invested before are now investing using these platforms. This hearing is a reminder that with complex situations, we should take time to understand what actually did or did not happen, especially with this GameStop situation. Now, the SEC is the proper authority to determine if any rules were broken, and they are looking into it. Congress has already given the SEC broad authority to oversee the capital markets, and we do not need to rush to enact even more big government regulations until that could ultimately harm the investors. Now, question, Mr. Tenev, can you remind us again why Robinhood temporarily paused trading of GameStop and other stocks?
Of course. Thank you, Congressman. Robinhood paused trading temporarily, or I should say paused buying of about 13 securities on Thursday so that we could meet our regulatory deposit and collateral requirements.
Okay, so what you're saying is you were paused because you had to comply with regulations. Is that true?
Correct.
All right, so it's ironic that the people who are criticizing brokerage firms because they pause trading, which they sometimes have to do to comply with regulations, these same folks are now saying, we need to respond to this with more regulations. I would say if people don't like brokers occasionally having to pause trading, I'd suggest they look at the regulations that required it. At some point, we need to recognize that piling on more and more regulations only increases complexity and does not help investors. Question for Ms. Schultz. Despite the volatility and the frenzy of media and social media activity, it seems to me like the markets functioned as they were supposed to during this situation, and that markets are not broken. In fact, they are working well. Do you agree with that?
I agree with that.
Okay, thank you. I appreciate that. I think most reasonable people that are listening to this would agree that there are regulations in place. The SEC has those to pause activities that could be harmful, not only to the markets, but to the individual investors. And so what I'm understanding you saying is that it did work in the way it was supposed to.
As the facts that I know now, it does appear to have worked the way it was supposed to. This is not a sign to me that the market is broken.
Thank you. Mr. Griffin, what are some of the issues that policymakers should consider in the T+2, T+1, T+0 debate? Obviously, margin requirements exist to make sure firms have enough capital to settle transactions, but faster settlement and lower margin requirements can be positive for the retail investors, and we need to balance those needs. Can you address what some of the issues are in the T2, T1, and T0 debate?
So, Congressman, I cannot profess to be an expert on these issues, but I will give you my perspectives from having been in the industry for 30 years. We started at T5. We will one day be at real-time settlement. And the question is how long does that journey take? From T2 to T1, which reduces the amount of capital required by broker-dealers to meet the needs of their customers, that reduction in capital will be meaningful, would have been very helpful to Robinhood during this period of time. Reduces counterparty risk holistically, which is good for everybody in the market. We should push for T1. As we go to same-day settlement, you now bring into question the complexity of intraday cash movement, and you bring into play the necessity for all systems to be functioning every moment of every day with no room for error. At a T1 settlement cycle.
This time has expired. Let me remind the members that we're going to have a series of hearings. Today is the first. There will be probably two more. I didn't hear anyone here today say that they were ready to pile on regulations. So let's make sure we know that our statements are accurate. Mr. Foster, you're recognized for 5 minutes.
Thank you, Madam Chair, and to our witnesses. Mr. Tenov, I'd like to follow up a little bit on payment for order flow and best order execution issues. Democratization of finance is a good and noble goal, but for democracy to work, consumers need transparency and high quality information, and not only about fees, but about order execution quality. Your customers actually don't care directly about who you subcontract order execution to or any payment for order flow, but they need a simple way to compare the execution quality between your app and competing apps or other accounts. And while institutional investors can afford to run their own tests, and they do, and I'm sure Mr. Griffin is normally is quite often on the receiving end of those tests and trying to measure up to his competitors to compete for market share there. The institutional investors have the market power to demand best execution statistics for their prime brokers. And everyday investors do not get the same transparency. In fact, I believe there's an SEC rule 606, that requires brokers to disclose at least some order execution data to institutional investors. But this requirement does not apply to retail investors. So, Mr. Tenov, since Robinhood's mission is to democratize finance for all, I ask, what are the mechanisms that you would accept and support to provide transparent order execution quality statistics so that your customers can engage in a clean apples to apples comparison between other brokers, between your app and other people's apps in terms of the total cost of trading?
Thank you, Congressman, for that very important question. I'm generally in favor of a greater amount of transparency than what we've typically seen in the financial industry. And recently, Robinhood and me personally have engaged publicly on the topic of payment for order flow, short selling, and of course, T+2 and real-time settlement. We do publish 606s via Robinhood Securities that detail our payment for order flow arrangements with various market makers. And just this past year, the industry implemented more detailed 606 requirements, which we of course conform to. Also, back in December of 2020, we released a public page on our website that provided detail about the execution quality, including price improvement that our customers received. And we're proud to announce in 2020, our customers received in aggregate over $1 billion of price improvement on their executions.
Right, but that's not a comparison to your competitors. You know, there are a lot of questions about the accuracy of the best execution reference price. And independent of whether it should be improved, it seems like if I was a customer of you or one of your competitors, what I'd want to see is, you know, I just executed a trade of $2,000 and on average I got X% better or worse than a reference price. And then over time, and see not only the trade that I just executed, but perhaps a running average over the last month or two that you can compare to the running average of whether you're exceeding some benchmark for trade execution quality that can really be compared with potential competitors. And is that a workable system? Are there difficulties? Is there a reason why industry shouldn't move that way in the name of transparency to customers?
Congressman, this is a very interesting topic to me. I'd love to have the conversation. I don't know if this is the right forum to necessarily ideate and brainstorm on all the solutions, but I just want to say I'd be happy to engage with this in a detailed forum and figure out the right path.
Okay, well, yeah, we do intend to continue to engage with the industry on this subject because it's very easy to make payment for order flow sound really creepy. You know, you're basically selling a list of rubes to the sharks. Okay. On the other hand, you make part of an argument that this can net out positive for consumers, but for it to fully net out positive, they have to be able to make the apples to apples comparison. And so that's, I think really an important issue. And I think that probably your reaction to that, if you found your customers were leaving you because of poor execution quality, you would do what large funds do, which is to split your order flow between multiple order execution firms and then demand of them the best order execution and move your business to whoever does the best for your customers.
Yes, well, Congressman, we already do that. We have 7 market makers.
Mr. Mooney, you're recognized for 5 minutes.
Thank you, Madam Chairwoman. So let me just start by saying that last Congress, 30 of my Democrat colleagues, 4 of whom on this very committee, co-sponsored a bill that would impose a financial transaction tax on the purchase of securities and certain derivatives. And just recently, after the market volatility surrounding GameStop in January, Democrats renewed the call. Many Democrats anyway, renewed the call for a financial transaction tax. On just January 28th, Congresswoman Ileana Omar tweeted, "How about this? Financial transaction tax now." Congressman Peter DeFazio is the lead sponsor of the bill. He's already put the bill back in for this session of Congress. It's now House Resolution 328 of 2000. So it's called the Wall Street Tax Act of 2021. I actually have a copy of it from the last session here. It's in again now. And he says, Congressman DeFazio says that a financial transaction tax would, quote, help create a more level playing field for Main Street. So with that background, Mr. Attentive, this question is directed at you. The Robinhood platform has more than 13 million users, and most of them are small dollar retail investors. If the federal government levied a 0.1% transaction tax on the sale of securities, and I know one of my colleagues, French Hill, my good friend, mentioned this earlier, but I want to expand upon it a little more. How would that 0.1% transaction tax on the sale of securities affect your platform and the retail investors that are your customers?
Thank you, Congressman. And we'd be happy to engage in this discussion much more in the future. A 10 basis point financial transaction tax would eat into the returns of our customers, which, as you pointed out, are largely smaller investors. And in that sense, it would be a cost to the retail investor. Of course, that would have to be weighed against the potential benefits of this tax. And I know it's a more complicated issue than meets the eye at first glance.
Okay, well, thank you for that answer. My next question is actually for Jennifer Schlupp. I know you spent your career specializing in financial regulation. In your expert opinion, would a financial transaction tax directly prevent fraud or market manipulation?
No, I don't think a financial transaction tax would have an effect on fraud or manipulation. I also don't think that it ultimately, financial transaction taxes often fail to raise money, and they distort trading in a way that's not necessarily foreseen initially by the tax. And I'd like to just add in there as well that financial transaction taxes, while they initially might seem like a small imposition on an individual investor, those taxes often hurt individual investors and their long-term retirement goals by affecting the institutions that also do the trading in mutual funds and with retirement money. I don't think a financial transaction tax is a good idea.
And a quick follow-up to that, Mr. Schlupp, what do you think a financial transaction tax would have done anything to prevent the market volatility and disruption we saw just this past January?
No, I don't think it's related here. There's been some discussion that it might have decreased the amount of trading and thus changed the volatility. It's not my opinion that would have had any effect on this particular circumstance.
Thank you. I only have a minute left, so let me just summarize. The financial transaction tax, supported by many Democrats, would do nothing to prevent market manipulation or fraud, would have not prevented the market disruption in January, and most importantly, would hurt retail investors. Yet Democrats are claiming that the events surrounding GameStop and Robinhood in January make it imperative to implement this financial transaction tax. It just doesn't add up. A financial transaction tax would make it more expensive for small retail investors to trade. And so much for looking out for Main Street. I believe we should be working together to find ways to open up markets to retail investors, not close them. Instead of making trade more expensive with a burdensome tax, let's look for ways to empower retail traders. Thank you, Madam Chair. I yield back.
Thank you very much. Ms. Beatty, you're recognized for 5 minutes. Ms. Beatty?
Thank you, Madam Chairperson, and thank you to the witnesses. My first question is to the CEO, President Ken Griffin. In the first 3 quarters of 2020, your company paid online brokerages like Robinhood $700 million for their order flow. Do you believe that brokers like Robinhood can service the best interest of their users while selling their order flow to companies like yours? And that's yes or no.
Congressman, I believe that Robinhood actually goes further in meeting the best interest of customers by, in fact, routing their order flow to Citadel. We give a better price, a better execution for American retail investors than the alternative of going to exchanges.
So I'm going to take that as a yes, since you said they go further. Then can you tell me, why did your company urge the SEC to ban the payment for order flow models in a filing to the SEC?
Congressman, that is a terrific question. That filing relates to the U.S. options market. It was a filing back, I believe, in 2004. And in the U.S. options market at the time, trades were committed against listed quotes. We were apprehensive about the direction in which the U.S. options market was heading towards the existence of these price improvement auctions, which diminished the incentives to aggressively provide bids and offers in the options market. We felt that legislative or regulatory efforts to encourage tight quoting, to discourage the existence of these auctions,